Welcome, everybody. We wanted to take a little time today to go through the new tax law updates that we know about. So, in July of 2025, there was a new tax law that was signed into law. And so, the point of today is to go through some of the things that we felt were pertinent. So, without further ado, I want to introduce Dave Treadle, who's the CFP here in our office. And he's going to go start the slides and go through a few of the updates that we have. So, go ahead, Dave.
All right, thanks, Aaron. Just to start, a lot of times we blow through disclaimers, but for this presentation, it's actually pretty important because although the law has been signed, it still must be interpreted and implemented. So a lot of clarification is still needed. So what we're basically saying is this is a great starting point, but none of the specific details or anything like that are finalized, written in stone by the IRS. So please keep that in mind. We might go a bit fast today, but of course this is recorded, so you can go back and listen to any parts that you may have missed. But from a high level, please focus on kind of the categories and what the changes look like. And then as we get clarification, we can get more into the specifics. So as Aaron mentioned, the law that was signed in July 25 included quite a few provisions, but we're going to focus just on the tax portion of those provisions. So what we're going to talk about is existing tax laws that are made permanent, new permanent provisions, new temporary provisions, tax provisions that were eliminated, and then other notable tax updates. Now, keep in mind throughout this presentation that anytime we use the word permanent, that only means it's not scheduled to end. If Congress enacts any new tax legislation at any point in time, these could change. So that is what we mean by permanent. So let's go ahead and get started with the provisions that were made permanent. So, of course, most of us have heard that in 2017, we got some lower tax brackets, and those have been made permanent and will adjust for inflation. So the tax brackets will range still from the 10% bracket to the 37% bracket. In addition, the new higher standard deduction has been made permanent. And you can see for 2025, for a single filer, that's actually gone up to 15,750. And for married, the standard deduction is now actually 31,500. For seniors age 65, Aaron's going to cover this a bit later, but there's actually a little bit even better news. So keep that in mind. Charitable donations, we still have the ability to deduct up to 60% of our AGI through cash donations, but what's new and different for 2026 is there's now this 0.5%, what you could call a floor. So the first 0.5% of your charitable donations that you're going to be itemizing will not be deductible. So if you make $100,000, for example, and you donate $5,000, you can only deduct 4,500. The first 500 would not be deductible. That's a mouthful, and I know it's a bit strange, but that's kind of what we're dealing with here.
Yeah, and Dave,
Uh,
that's a little bit like the medical deductions for a lot of people. If you remember, like 7.5% of AGI has to be passed before you can start deducting medical. So I think it's the same kind of thing with charitable. I feel like it's just the 0.5% that sounds a little strange. So
yeah,
anyway.
yeah. Thanks, Aaron. Appreciate that.
Mhm.
The child tax credit was increased in 2017. It's being increased again. Now it'll be $2,200 per child under age 17, and that will be adjusted for inflation. And in addition, there is the $500 credit available for any dependents that are over age 16, excuse me. All right, so the mortgage interest, where you can only deduct the mortgage interest on the first $750,000 of your loan, is made permanent as well. Again, this applies to those purchases made after 12/15/2017. If you remember, the limit before that was $1 million. So again, $750,000 mortgage, you can deduct the interest on that up to the 750,000. And just real quick here, because this really doesn't affect all of our taxpayers out there, but the limit on itemized deductions for those who do reach the 37% tax bracket, there is a haircut on those, so be aware of that starting in 2026. And again, that's only if you're in that 37%, the very top tax bracket. All right, miscellaneous deductions eliminated. So if you'll remember back before 2017, we had the section on your itemized deduction of your tax forms for 2% miscellaneous deductions. And so there's various categories of expenses that qualified, and if you spent over 2% of your AGI on those expenses, you could deduct them. So that is actually still gone, so made permanent as well. And you can see that includes things like unreimbursed employee expenses, advisory, tax prep fees, things of that nature. So what's interesting is the educator expense. So we did have an educator expense, and it was capped, since 2017, I think was when they updated it, and it's currently capped around $300, and that has nothing to do with your itemizations. But now that cap has been lifted, and what's kind of a little bit uncertain is how that will work, um, because now they are saying that your education, well, we think maybe that you're to take these deductions, you have to itemize. So we'll get clarity on that and make sure that we handle that correctly for our clients out there.
Yeah, and the big thing there is for the teachers out there who spend a lot in their classroom to know that they just need to keep up with all their expenses that they're paying out of pocket because they're no longer just capped at the $300. And so I think that can be a positive thing for our teachers and other educators.
Yeah. Thanks, Aaron. And the last thing that I just wanted to mention was one that gets a lot of press, and that was the big increase in the estate and gift exemption. That jumped in 2017, and that has actually been made permanent as well. So you can see that is in 2026, it'll be up to $15 million per person. So keep that in mind if that does affect you in any way. And so that was kind of like the basic provisions, but now as we move into the more of the nitty gritty, I'm going to hand it over to Erin so she could do the heavy lifting here.
Yeah, and before you leave this slide, the qualified business income, that's only going to affect people who are self-employed. But that 20% deduction that is taken on the tax return is now permanent. There was some talk about it going away at the end of this year, and then also the alternative minimum tax. So it's higher, which just simply means less people are going to be subject to it, which is a good thing. So, all those things, if you were worried about these things they're now permanent. So that's a good thing. Yeah. So. All right. So now we have a new permanent provision. So this is a brand new law, but basically it's subject to it's charitable giving, and what we're doing is we're taking kind of an above the line deduction for charitable contributions. We've seen this in the past. We'd have a year or two where we get a little special charitable giving. I think the last time I remember it happening was maybe during the 2020-ish time frame. But now we've got a $1,000 deduction for an individual or 2,000 for married couples. This is in 2026. You will not have to itemize to take this. So if you're a charitable giver, this is a good way to take advantage of getting a deduction without worrying about itemizing your deductions for any charitable gifts that you give. So that's something to keep in mind as we kind of head into 2026. Then we've got this is kind of a big one if you're a CPA, to be honest with you, is the SALT, or state and local tax deduction. So what we have here is that the state and local tax limit, I'm going to call it SALT because it's a lot easier and it's not as much of a mouthful, is now increased to $40,000. And you might be like, well, what in the world is this? Well, it's basically any kind of state tax withholding and your property taxes on your cars and your real property. And so like your house, for example. And so we've had a $10,000 limit basically since 2017. And what that means is if you're in a high tax state, say North Carolina, California, anywhere like that, then you are limited to $10,000. Well, your property taxes on your house and your vehicles could almost equal $10,000. And you're not really getting the benefit of the state tax deduction. And so that $10,000 limit has meant for a lot of people that they were not able to itemize. If we think about where the standard deduction for a married person, let's say, is $30,000, you were limited at 10,000 with the state and local. And really the only other thing you could add to that was charity and mortgage interest. And so now we've got a situation where if you do give $40,000 in state taxes and property taxes, then we're actually going to probably hit and be able to itemize your deduction. So this is a big deal. Even if you don't think it's a big deal, it's a big deal, especially for people who live in high tax states. Because now suddenly that $40,000, if you're going to be up over that 31,000 pretty easily. And so we're going to see a lot more people itemize their deductions. We say it's temporary because this is only lasting until 2029. And then after that, we're going back down to $10,000 again. So it's just something to keep in mind. A lot more people are going to itemize, and this does start in 2025. So you're going to see the benefit of this right away. Also, Dave kind of told us about this already, but there's an additional senior deduction. And so this is for people over age 65. One thing I do want to point out, you do not have to be taking Social Security to be eligible. You just have to be over age 65. And you're going to get a $6,000 per qualified senior. It's an extra deduction. You kind of almost have to think of it, like Dave said, like an extra standard, it's a personal exemption or whatever, an extra standard deduction. It is phased out. 75,000 for single, married is $150,000 of income. So if you make over that amount and you're over age 65, you might not receive the full 12,000. But it is something 12,000 married or 6,000 single. So it's a benefit. We're trying to add that into our 2025 tax planners as well because it does affect the current year tax return. This is something that got a lot of talk, which is the taxation of tips and overtime, and specifically to not be taxed on tips and overtime. I'm not going to spend a ton of time on this. You can kind of see that tips, it's up to 25,000. The big thing that I see with this is that it does have to be reported on the W-2, which means that the payroll provider for whoever you work for has to report it on the W-2. Keep in mind in 2025, the W-2s are not going to change. And so it's going to take an extra code somewhere on the W-2 form, and it's going to, and for people who are in a tip job, they're going to have to report their tips to their employer. They're going to have to single it out, and then it's going to have to come through on the W-2 in order for it to be included. So we'll see how many of the payroll providers are actually going to be able to get this done before the end of the year, but that's the hope anyway. It's the same kind of thing with overtime. It's 12,500 or 25 for joint. It's only qualified overtime pay. One thing that I think is interesting is only the incremental overage. So if you get time and a half for working overtime, you only get the half part as the incremental overage. You don't actually get the whole dollar amount that was overtime. It's still going to be subject to Social Security, Medicare, both of them. And again, it has to be reported on the W-2. And all of this, I think, is going to expire in 2028. So just keep that in mind as well. All right, another one that's getting a lot of talk, especially probably by the auto industry, the people trying to get you to come in and buy a new car. So in 2025, so this current year, you're going to be able to take a deduction on auto loan interest. Now, I've never seen this in my career. And so I've never seen us be able to kind of deduct auto loan interest. It's pretty common to do mortgage interest, but not auto loan. It has to be a new car. And its final assembly has to be in the US, so you can kind of see what they're pointing to there. I'm not sure how we're going to keep up with all of this, and I'm not sure they know either, but that's kind of the point. It's for new auto loans that were incurred after 2024. You can refinance, but again, it has to be the right type of car as well. So I'm not sure exactly how that's going to work out. There's a phase out on income, which we have up there. And for this, you also do not need to itemize. And so that could be helpful for some people. $10,000 though, Dave, I will say is a big auto loan interest. If we,
I was just going to mention that.
you'd have to buy a pretty big car or a pretty expensive car to get up to $10,000. I guess you could get multiple cars maybe, but anyway, so that's kind of the new law there. All right. These are some eliminated provisions, things that are going away. And I'm not going to spend a ton of time on it. The big thing is that, oh, we got a typo. I see it. The $7,500 electric vehicle tax credit, it ends on September 30th. It's just, you got like 12 more days, I guess, to go out and buy a certain electric vehicle and get a credit. But a lot of the phase outs and the law repeals are on electric vehicles. We're also seeing an elimination of the premium credit, so ACA plans. So health insurance, basically, if you make above 400% of the poverty limit, then we're not going to see any tax credits for ACA plans. And then the personal exemptions, which I kind of talked about. We used to have itemized deductions plus personal exemptions. Well, personal exemptions went away in 2017, and that's now completely gone, and we don't see it coming back anytime soon. All right, another thing that people are talking about, Trump savings accounts. So these are for children. And basically, what I can understand about them at this point is that they're kind of like an IRA, and you can establish it for children under age 18, and parents can contribute up to 5,000 a year. I think that employers could also make a contribution, 2,500. I think that might be for the lifetime of the account, but I'm not exactly sure. The distributions cannot start for these accounts before the child turns 18. There are some caveats to that, education and so forth, but we have to get further information on that. And there's some type of a tax credit that's going to happen for children who are born between January of this year and December 31st of 2028. It's $1,000. I think it's if you open the account. Um, and it seems like these are going to be treated like an IRA in that a child can then use it to maybe do Roth conversions once they turn 18, or they kind of leave it deferred until they're 59 and a half. You cannot open one of these accounts until basically next July. They gave themselves a year to kind of figure out all the information about it. And so we're going to kind of wait and take all of that time, and obviously, and then we'll probably know more about it at that point. But right now, that's kind of what we know. And we kind of put all over this slide, more information is needed. So, all right. Some other things, 529 plans. A lot of people are using 529 plans for education expenses. We like 529 plans where we see a lot of our clients open them for children and grandchildren. And what we're seeing is of even further expanded use in that they can now be used for like standardized tests, college entry exams, continuing education once the child is working. I think they're just expanding kind of what if they don't go to a 4-year university? Can they use it for other things? And so the answer is it seems like yes. And beginning next year, you can use $20,000 per year per student for elementary and secondary tuition. So that would be, private high school, private middle school. That number used to be $10,000. So it's gone up there. And so, that helps people who have 529 plans and have children in private school. I think this is probably a good thing. And then student loans. So there have been a lot of provision changes in student loans. It seems like the forgiveness for death or disability is still tax-free, and that's permanent. But there's a lot of other changes happening with student loan limits, repayment options, protections, all of that stuff. Lots of different implementation dates on this, July of next year being a significant date. And the big thing I think that is going to be affected based on the information I'm reading is that it's not going to affect undergrad student loans as much. It will maybe affect graduate loans. And then also, I think there's going to be a lot more effect on parent loans. So, the amount parents can borrow in their name versus the student's name. So it's just some things to keep in mind. We need a lot more information on this, but that's some things that people are talking about. All right. That kind of sums it up. Anything else you want to add, Dave?
No, that was pretty good, Aaron.
All right. Well, if anybody has any questions, feel free to rewatch this, send us an email, call us anytime. But we hope this is helpful just to kind of lay out some of the things that are going on with the tax law and some of the things we think we can take advantage of in 2025, and then some things on the horizon for 2026.
Well, I guess, Aaron, to those out there, if you think you might be able to itemize, track those receipts as well. As I
Yep. Yeah, I think more and more we're going to see people need to track their receipts for charitable, educator, and I think more people, to your point, Dave, are gonna itemize. So for sure. All right. If anyone has any questions, feel free to give us a call. Y'all take care. Bye bye.